Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq market site is Marex, Senior Director of Index Research and Development with Nasdaq Global Indexes, and Ryan McCormack, Factor and Core Equity Strategist at Invesco. We're here to discuss performance in the Nasdaq-100 following the first Fed rate cut since March 2020 and recent trend of global central banks beginning to pivot away from extremely restrictive monetary policies. It is great to see the both of you, as always. Welcome back to Trade Talks. And a lot has kind of happened in a month, and the Nasdaq-100, Ryan, has relatively digested all of the policy changes pretty well.
Yeah, clearly a lot has happened. Like the event that we've been waiting for now for what seems like 2 years finally occurred, and maybe a little larger than a lot of people had anticipated with that 50 basis point cut. But I think it largely has digested the news. I mean, when you look at sort of performance like what we saw in July, it seemed like kind of that broadening out story really took hold, right? You had mid caps outperforming large caps, small caps outperforming mid caps, you had value outperforming growth. And then August into September, we kind of saw Nasdaq right the ship, or the Nasdaq-100 right the ship, and we saw sort of this the focus back on some of the large cap growthy names. You know, I think it'll be interesting to see here over the next 3 weeks as another earnings season comes to the front of the mix, which is always a really big event. So, you know, I think ultimately all the noise around the Fed cuts, all the noise around policy, it sort of gives way, in my opinion, to each quarterly earnings report, because ultimately, you know, the fundamentals of what is the driver of this Nasdaq-100 story.
Yeah, it certainly is. And by the way, we have a presidential election that's going to be thrown into that earnings mix as well. But, you know, the question turns to, Mark, whether or not we will get the speed and size of Fed rate cuts that perhaps the market might have expected, because the data that's been coming in has been quite strong.
Yeah, I mean, look, I think noise is the key word that I picked up from Ryan, which is that there have been so many hurdles, if you think about the last few years, thrown up in front of this index. And you know, 2022, those were real hurdles in terms of historically high inflation, historically sharp, steep rate hike cycle from the Fed, right? Nasdaq-100 suffered in 2022 when everybody said, look, growth is going to underperform. Future cash flows, future earnings are worth less today than they were yesterday, with rates at 5% versus 0. And that was sort of a easy to understand sort of theoretical story and explanation of underperformance, but obviously completely missed generative AI, which got going at the end of 2022. And you know, obviously led to multiple all-time highs for the index. With today's gains, we're actually, I think, within 3% of those all-time highs in July. And so whether it's, you know, the rotation away from growth towards value, away from large caps to small caps, away from US to international, right? Like all these things that we started to talk about again in July that led people to think, okay, now the Nasdaq-100 is going to start to underperform again. We still turned in a gain for Q3. We're still up 20% year to date, and it's driven by this really long-term underlying growth driver, not just of generative AI, but just broadly speaking, tech being the growth driver in the modern economy, and we're not seeing that slow down at all.
It's just so interesting, because if the Gen AI story wasn't in there, I wonder what the picture of the overall market would have looked like. But it goes back to what you were saying before. One of my favorite charts that you both utilize is R&D within the Nasdaq-100 companies, and because of that R&D, we have the AI story, right? It's not like AI is anything new, but the Gen AI that became part of the consumer vernacular, and how we're not only using it in terms of products, but internally as enterprises, we are leveraging it in virtually every single way. You can even apply that to academia and elsewhere. And that's because of this R&D.
Yeah, and you know, I think when we take it a step further, I mean, Mark has done a ton of work on the patent data, right? Which to me is probably one of the most exciting charts that we update. And it's, but the story is, this was not something that's happened in the past year. Right, I mean, these patents, this kind of long-term investment in these companies has been going on for years. Where like a lot of the infrastructure for this was pretty much stood up. So when it was almost ready for AI to like come into the spotlight, like a lot of that had already been built. But you're absolutely right. I mean, it all kind of flows back to companies that aren't afraid to spend on R&D, which inherently is going to be kind of this longer-term project.
Right, and then with interest rates coming down, it's also going to make the cost of capital less expensive for these companies. I mean, of course, these have solid cash balance sheets anyway. But it's interesting, Mark, the news that came out of China, it's almost as if it happened, the markets were closed there, and then the story went away. It feels as if the Nasdaq-100, it's really focusing on the fundamentals more than anything else, to your point earlier.
Yeah. I mean, look, I'm not a China expert by any stretch. I'm personally a little bit skeptical of how self-fulfilling this, newest round of stimulus can be, because they have announced measures in the last few years. We've had, maybe not as sharp of a rally the last couple of times they did this, but there have been rallies that have fizzled out and just have not been able to overcome some of these really structural headwinds in China, whether it's demographics, whether it's the overhang of debt and real estate and just too much infrastructure build out over the years. There are structural problems in China that I think, for me, make me very skeptical of overweighting or reallocating a portfolio there. You don't have those structural problems in the US, and the China exposure of the Nasdaq-100, it's there, but it's never been the primary driver of the growth, right? If you look at, where revenues are growing, it's predominantly in the US, it's in other developing nations, it's within other developed markets like Europe and Japan, right? And so, going back to Ryan's point earlier about R&D, we do this analysis every quarter. We update every quarter how much are Nasdaq-100 companies spending on R&D. If you compare the latest numbers, Nasdaq-100 spends 10 times more on average on R&D than if you look at the rest of the S&P 500 and you strip out the Nasdaq-100 companies from it. That's an order of magnitude difference, right? And you really need to, as an investor, I think, understand why that disparity is so large. It's because growth in this century is disproportionately driven by innovation. You have to spend money on innovation. You cannot acquire your way to innovation. You cannot financial engineer your way to innovation. You have to spend it on things like patent development, and that's one of our main focuses at NASDAQ Indexes, is coming up with the research that supports that story to say, this is where you access innovation-driven growth better than any other benchmark you can find in the US or globally.
Yeah, and when you hear about the stats that Mark just cited, that justifies the multiples that you're seeing in many of these names.
Yeah, I mean, and it goes back also to, the cash balances that you had referenced. Also, just these companies are better capitalized, right? So there is that quality component as well. I think it's worth it to pay a premium for things that are growing faster, ultimately, at the end of the day. You also have kind of the conversation about things like intangibles, right? That's not going to show up in PE, and things like patent valuations aren't necessarily going to, they're not going to show up. Like, that intangible value has been a pretty significant driver, I think, of interest in this group of companies. Things like brand value, right? That they mean something, but you can't necessarily bake it into a PE equation.
Right, which is so interesting with the research that both of your teams do, that you find these little nuggets that you might not necessarily find so readily available on what you would consider traditional Wall Street analysis. But even if you think, should the economy, take a slight downturn, not that that's an expectation at this point, but the types of companies that you're investing in, whether it's tech, the cybersecurity weighting that we have within the index itself, this is where companies are continuing to spend, if not pick up their spend in areas like that. So it's not just specific to what you're seeing with Gen AI either.
Yeah, and I think the interesting thing is, like, we're starting to see the offshoots, or like the tree branches are developing in AI, right? Like, initially it was always just like, how do I get access to AI? Well,
like
invest in
NVIDIA,
semiconductors, right?
Yeah.
Then it's, okay, now let's invest in the data owners. But from here, I think it gets really interesting, because like the map is still very much being written. You can go in a lot of different directions, and just recently you saw the partnership between Microsoft and Constellation, right? Okay, so now you have the power component. Like, where are we going to be sourcing the energy to run these data centers? So seeing that 20-year deal, I thought, was really exciting, and of course Constellation being a Nasdaq-100 holding, where you can kind of see like the ecosystem getting a little bit broader, and I think the real world uses and kind of the real world fundamental drivers of AI are beginning to kind of come into the fold.
Yeah, and that's really where you're seeing it too when it comes to energy demand driven by these tech companies. I mean, we just had the UN, General Assembly in town, and climate tech, of course, was one of the biggest conversations there, and it was more related around the energy demand that tech companies are creating. I don't recall ever hearing it so focused on how tech is driving this more so than the actual climate conversation. And it's kind of fascinating to think about it in that respect.
Yeah, I mean, I think the part that is difficult to quantify right now is just how much more energy efficient the large learning models, large language models for AI are going to get over the years, right? That curve has been steeply declining. Sort of the more advanced these models get, the more efficiency we're able to kind of squeeze out of them. But overall, the demand for the output is increasing, right? Companies are building more models, whether it's sort of proprietary, smaller scale stuff for a single use case, or obviously, you know, the big global models from ChatGPT, Llama from Meta Platforms, Google Gemini, right? It is a massive, massive increase in power demand that in the US we actually haven't seen in over a decade. We've had sort of flatlining electricity consumption in the US because even though we've had a lot of growth, we've been getting more and more efficient with the way that we use electricity in the US. That, for the first time in a long time, is reversing, and we're actually seeing an uptrend now in electricity demand, and no one, I think, knows exactly how far up that is going to go. But I think it's a very, very interesting bet to make on where you're going to see a lot more innovation going forward, is how to optimize the not just raw energy input that you need for training and running these AI models, but how do you sort of reduce everything around that in terms of, you know, things like smart meters, software to enhance smart grids, making sure that energy is stored, transported, and delivered as efficiently as possible.
And that's where it makes sense to, Ryan, your point, following the money in terms of companies like Microsoft, where they're investing those assets to satisfy the energy demand that these products require.
And we've talked about this before, right? I don't think it's one way or the other, right? It's not, we don't lean strictly on the AI architecture getting so efficient, and it is heading that direction, right? I mean, just significant less power consumption needed to generate a similar output. You're just seeing more models. And it can't be strictly like, all right, we have to wholesale upgrade the entire power grid, because in reality that isn't feasible. I mean, we can tap into nuclear power, and I think that's interesting. We're starting to see that with this Constellation deal and a handful of others. I think the solution ultimately is you got to meet somewhere in the middle, right? Efficiency from both sides, upgrading of the power grid and energy generation, and then on the other side, just kind of the continued advancement of some of these AI architectures that we're seeing.
All right, appreciate both of your insights. Thanks for joining us on Trade Talks, and thanks for joining me from MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.